The Fed walks back talk of a September pause in rate hikes as jobs numbers come out strong. Yields swing back towards recent highs, taking dollar-yen to levels not seen in 20 years. Stocks managed to hold on to some gains ahead of CPI, FOMC, and OPEX next week. And finally, China starts to outperform. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 7th of June, and let's have a look at these markets. So last week, big moves again in rates. That was the big driver last week. We had Bank of Canada hike 50 basis points. We had ECB European inflation data come out hotter than expected. And that kind of puts pressure on the ECB this week. A lot of expectations on them to come out pretty hawkish. And we saw a large sell-off in the entire European yield curve. We had, Fed speakers Brainard and Waller walk back Bostic's comments around a potential September pause. And all these things really, igniting that move in rates. And that move before, the dovish sort of rhetoric had been the reason why equities had rallied 6% in short order, plus a bit of month-end buying. Those were the things that were being touted as the reasons why we were rallying. A lot of that sort of rhetoric getting unwound. But despite that, equities managing to hold on to most of their gains, right? So equities hanging around that 4150 area, not far off the 4200 highs that were reached. And then, Japan and China actually outperforming and rallying a bit on reopening in China, stimulus, optimism, things like that. Things that we've been kind of flagging may well be coming, and starting to finally see a bit of that outperformance in China that we were looking for. Let me just share my screen here. Dollar yen as well, big mover, back through the highs, 20-year highs now in dollar yen, at like 132 and a bit, as the treasury yields, 10-year treasuries broke back above 3%, and that correlation is extremely strong. And then dollar relatively stable against other majors, bouncing slightly off support levels. And then finally, commodities kind of flattish, again, with the exception of copper, which had a decent spike, about 5% in a day, kind of fading a bit now, but in general, putting that down to kind of China positivity coming through, and copper being a beneficiary there of that demand coming back online. So you can see here in the Sigma adjusted moves, kind of wall of blue, that's all the rates moves across the various regions. And then equities, kind of the orange bars, a little bit weak in some of the European and US equities, but nothing crazy. And you've got that outperformance in Asia. Commodities wise, like I said, pretty lackluster in the middle there, not a lot going on in other major commodities. And then really dollar yen, the big one on the downside, the yen really getting beaten up there basically, right? So that's what we're seeing. If we go over to sort of what are the main sort of stories that are going around and things to be aware of on the macro backdrop, I think earnings are quite important. So you've got S&P EPS held up relatively well in Q1, right? That's what the bulls are basically hanging on to, right? The only problem with that is if you look under the hood, you see that it was all driven by energy and materials, right? And again, we had flagged this about a month ago when we were talking about earnings ahead of earnings season. It was going to be driven by energy and materials, and what were we going to see in the rest of the space? So looking under the hood, you see the 3-month delta on EPS. You've got those two standouts at 52%. 12% of, and I think that's the share of the EPS, basically 52 and 12. And then you look at the rest of it, it's a bit of a mess right across the space. You've also got earnings revision breadth. This is an indicator that Mike Wilson at Morgan Stanley been a very prominent bear for quite some time. This is a measure that he looks at. That's rolling over. It's into negative territory now. He expects it to go even more negative. And he's calling for a target on the S&P at like 3,400 by middle of August. Consensus estimates for Q2 EPS look like 10%. Cloud cuckoo land, if you ask me, likely to get revised down. So as they do come through with downward revisions, and we're already starting to get Microsoft guiding lower on a stronger dollar, Apple being cautious on their services business. So you've got some of these big generals of the market even guiding lower, right? And they, those earnings have been bulletproof for how long, right? And even they can't escape it now. So I think those earnings revisions are coming, and that's probably going to take valuations lower, basically, right? So a lot of headwinds for valuations and for the macro backdrop and for earnings. Driver this week and things in the spotlight, you've got the ECB. So obviously we had the Fed for ages, doing what they're doing, and everyone hanging on to every word that Powell says. But finally, the ECB really kind of needs to now deliver on their hawkish message, right? So last week's Eurozone inflation data keeps pressure on them to lift rates. We're expecting them to confirm that they're going to raise rates in July. Whether it's 50 bips, 25 bips remains to be seen. Some people are saying they need to go harder, 50 bips, but I'm not sure they'll do that straight off the bat. But they're probably going to end asset purchases by the end of this month. Okay. If we look at what's implied in terms of European rates, we've got about 8 hikes priced in till the end of next year. And that's not a million miles away from where the Fed's pricing, basically, right? So quite interesting that as much hawkishness is being priced into the ECB as is the Fed, right? Which I find that quite surprising given where the relative rates are and the relative states of the economy. Looking back, now this is from Macro Alf, right? And Andreas Steno Larson. So, obviously these charts, they put them out on their sort of free platforms or whatever. So you had French inflation back in 89, 91. Okay, last time you had any real meaningful inflation. And that was at around 3.7% CPI, okay? And what they had to do to get that in check and get that back below target was they had to go massively through neutral rates. So at the time, they had neutral rates at around 4%, and they had to take European interest rates way through that, right, to get inflation back down. So now what's being priced by the market is maybe neutral rates are around 1.5% in Europe. Well, maybe we're going to stretch to 2%, and that's going to be enough to bring inflation back down, right? So it's not clear that is actually the case, and they might need to go much harder. Problem is, if they go too aggressive, how's that going to impact peripheral bond spreads? Okay, and we've already seen Bund BTP grinding its way up to 200 basis points, as Alf has pointed out as one of his sort of top trades to have that spread on. Apparently at the meeting, they're going to talk about some anti-fragmentation crisis tool, which is basically how they're going to stop peripheral spreads from blowing out, right? So we'll see, we'll get more detail on that and see if the market believes it or thinks it's credible. So that might be one way for them to prevent for them to come with a very hawkish tone, but prevent the bond spreads from blowing out massively if they say something along the lines of they're going to find a way to contain that and not let that spill over, where they can be more hawkish on rates because of German inflation, because of inflation across the whole Eurozone. They need to get it in check, but they can, not have this whole European sovereign debt crisis kick off again, basically. That's what they really need to avoid. So I don't know if they're going to manage to do it, but that's what the market's looking for. If you are a believer that they will come out with a hawkish surprise, because they kind of have to, they have to kind of get some credibility back, and rates are just ridiculously low in Europe, right? Nowhere near where they need to be. Then, and you think that they're going to somehow manage to jawbone their way to keep spreads in check, then the euro arguably has got a decent pop coming in it, right? So whilst I don't really want to take a load of dollar risk and trade it through euro dollar, because that, anything could happen on the dollar side of things, I think euro sterling in the super short term looks like an interesting long, basically, right? Because sterling, we're probably not going to get any new news out of the UK. Boris Johnson has just won his vote of no confidence, but in reality, UK economy looks horrible, and he's going to come under more and more political pressure. And so the situation doesn't look that rosy in the UK. So sterling's kind of a bit heavy on that. And if they do come out super hawkish in the ECB, euro could easily pop 2 or 3% on that, basically, right? So I think euro sterling longs present quite a nice risk reward just for that meeting and for maybe the next week or so, to play the idea that, yes, they are going to follow through and they're going to come out hawkish, and you're going to get a bit of a, whether it's short-lived or not, who knows, but you'll get a bit of a pop in the euro if they do that, basically, right? So that's the way I would kind of play that. And, you know, risk reward wise, you know, I think it's one of those things you can give yourself maybe a % of stop on the downside there. And maybe you're looking to make 2-3% on the upside in euro sterling. That's kind of move I could see happening in short order. Yeah. Okay. So that's the ECB. And then you've got obviously China waking up. So relative outperformance. We've been looking for that in China to materialize. K-Web had a powerful rally off the lows, up 25% since sort of May 24th. So that's pretty strong, massively outperforming NASDAQ. We started to see policy support, which is expected to maybe even increase into the CCP Congress that's happening, you know, sometime in autumn. COVID policies are loosening as the cases are, you know, back to near zero. Credit impulse is trying to bottom, and then EPS revision breadth is kind of bottoming out as well, it looks like, right? So a lot of signals there suggesting maybe we've kind of reached a bit of exhaustion to the downside, and now we're starting to see some positive price action in equities, right? And we're starting to see that even when S&P might be having a bad day, right? So that's the idea, you know, that's what we need to start to try and see to believe in this sort of China story, that second half China could really have a go at rallying, right, in a meaningful way. Yeah, and the reality is no one owns China, right? So everyone's just been buried in China and stayed the hell away from it. People got scared about potential sanctions as well after them supporting Russia. So, you know, China's just not owned. So it's likely that could re-rate a bit higher if things start to move in the right direction. How would you play it? A load of ways to potentially play that. FXI or K-Web call spreads, as we've kind of been mentioning, we're on the radar. I haven't managed to pull the trigger on those yet, but probably looking for dips to get into that type of structure. Relative value spreads, I mentioned on Friday's Discord chat. You could do sort of China versus Europe, maybe Germany, like a cool switch on the ETF side of things, something like that. Commodity plays, as I mentioned, copper versus gold could be a way of having exposure to that China story. So these are all potential ways to participate in China upside if that's the story you're going after, basically. Yeah. Then if we go to equities, sort of price action, S&P price action. So you can see it's been pretty range bound for a week. Been respecting that 4075 to 4200 range as we're waiting for a more material catalyst, which might not come until the FOMC. Yes, you can see that that's been the range that's kind of been respected. That 4200 upside resistance has been kind of the cool wall level being touted by Spot Gamma, where they anticipate dealers start to get a bit longer gamma and kind of cap the market. Anywhere between that 42 and 4300 area is kind of really where that seems to live, that positioning. Below 4075, I'm anticipating a slide down to 4000. And then if that was to break, then you've got this region between 3875 and 3800, which is really the big key support that we held sort of last time we were down at those lows, right? So in terms of news flow, you know, some of the reasons why the market got whacked last week was obviously walking back of the September pause narrative. CEOs like Jamie Dimon and Elon Musk expressing their concerns about the economy. And then you saw that reaction to non-farm payrolls, right? Good data has become bad data. So good news, bad news environment where, you know, a robust data on the jobs front gives Powell the license to be more aggressive on rates, right? And then that's kind of the dynamic we seem to be in right now. And that's the price action post non-farms kind of confirmed that, basically. If we have a look at expiration, you know, obviously June's a massive expiry, as was March. So quarterly expiries in options are massive. I wouldn't read I haven't got too much to say about the June expiry in terms of any pinning effects or anything like that. It does seem like the VIX expiries kind of having a bit more impact here on the VIX. So one of the interesting dynamics recently that I've been pointing out is that VVIX has been absolutely collapsing, right? And that's quite unusual when the VIX is, you know, reasonably elevated around 25 or more. So trying to explain why that's happening. Now, one idea that I kind of mentioned last week was the idea that, well, if people want to kind of own vol and they've got more confidence in owning vol, that they don't need to buy call options so much on the VIX and they'll just buy VIX futures. So that takes a bit of a bid away from the options on the VIX, and therefore the VVIX can be lower. Those people who own VIX futures might overwrite them by selling call options, right? So that provides some supply of VIX options. So VIX options are effectively what the VVIX is tracking, right? Now, this other point is that you've got quite a lot of open interest, right? So if you look at the yellow histogram on the chart, you've got quite a bit of open interest on VIX expiry next week between kind of 25 down to 21, 20 basically. And that's, you know, you look at every strike has got, you know, 150,000 odd options, which is a reasonable chunk of open interest, right? So the idea here is, so is that creating a bit of a pinning and a bit of support to the VIX and preventing it from going down? So if you look at the chart on the VIX seems to have found itself a bit of a floor, right? So even though, you know, we've got realized vol kind of turning lower, we've got the market finding a range, and yet the VIX is kind of tracking this 24.5 to 25 area of support, and it's not really breaking down very much, right? So maybe that's telling us, and then if you look at the VVIX, that's collapsing. So maybe that's telling us that dealers are actually long all these options, or long a large chunk of these options on the downside on the VIX. And so as they're long these options and they're going towards strike, what's happening? The options are gaining time value, they're gaining value, they're gaining theta, so they've got a big bleed to deal with, and they're offloading options wherever the hell they can to manage that theta. And that's creating this downdraft in VVIX because dealers have been caught too long that vol and they're trying to puke it basically, right? So I would say the VVIX price action is signaling dealers are probably long those strikes. If dealers are long those strikes, it probably means that the VIX doesn't absolutely fall out of bed into the expiry, even if the market doesn't do much, right? So VIX is probably going to have some support around those strike levels, right? And then maybe once that VIX expires, then VIX is freer to move, right? Whether it's to move up a lot or even down a lot, the VIX itself will be freer to move, right? So that's the kind of dynamic I'm looking for going into next week. And, you know, as it plays out, we'll kind of get a feel for whether there's a trade to be doing towards the end, you know, a pre or post FOMC trade based on the idea that VIX expiry has kind of happened basically, right? So that's what I'll be looking for. If we look at dollar FX, so DXY found some good support around that sort of 101 spot 2 area that I'd flagged. And, you know, that obviously was helped by the fact that the Fed dialed back the Bostic comments on the September pause. So that kind of gave the dollar a bit of a bid. Dollar yen's really the major driver, right? So here I've got the chart of dollar yen and I've got the 10-year yield in the US as well. And it's just pretty much tracking it perfectly, right? So that correlation is extremely strong between dollar yen and treasury yields right now. So we've got dollar yen touching 133 overnight. Now if QT takes long end yields even higher towards 3.5%, 4%, then God knows where dollar yen can go, right? In a long-term chart, 125 was that big resistance. We've taken it out clearly, right? And now, you know, who knows? We could even keep going as high as 140, 150, right? If these yields have really got some legs. And Kuroda is still talking about an unwavering commitment to powerful monetary stimulus, right? So, I mean, he's showing no signs of flinching just yet. There were some Japanese comments about, you know, not wanting the pace of that sort of weakening of yen to be that fast. So I think they care about the velocity of the move, but if the move is just kind of slow and steady and the yen just keeps falling, it doesn't seem like they're going to do anything to stop it right now. Yeah, they're quite happy to import that inflation by the looks of it, right? I haven't checked the inflation data in Japan to see if they've actually started to get any inflation in the system, but that's clearly what they're going for. Yeah. If we then look at bond equity correlation, right? So that's obviously been, you know, in the headlines. This year has been horrible for anyone who's been long both bonds and equities. You know, balanced portfolios got annihilated. But, you know, recently, if we look at the chart on the top right, we can see that that's TLT and SPY. And you can see the 21-day rolling correlation flipped negative to negative 25% from a high of, you know, plus 60%, right? Well, actually not this year. This year, the high was more like 40% positive. But that's winging around quite a lot, that correlation. We'd said we'd started to see that correlation flip where weak equity prices were giving a bit of a bid to bonds as growth concerns were taking over. Well, that seems to have changed a bit again, right? Inflation break-evens have popped again. We've seen rates obviously back up. 5-year yields, you can see, have kind of moved quite dramatically. It was really the belly of the curve driving the move last week. So 5-year yields have kind of gone, and S&P's managed to shrug that off and not followed them, basically, right? So that negative correlation seems to be holding for now. And the question is, you know, if yields take out the highs and they're pretty damn close, right? 5 years especially. If you just take out the highs again, are they going to drag that correlation back to positive and take equities lower with them, basically, right? I suspect if we do take out the highs in 5-year yields, then yes, that probably is the case. Providing we don't get some super low inflation data that makes everyone think inflation definitely peaked and stuff like that, then I suspect that correlation is going to get dragged back into positive territory. And you can see it's quite choppy, right? So just sort of watch out for that. And if that were to happen, then you're going to get this kind of catch down in the S&P where, you know, it might have 100, 200 points catch up to where rates are, basically, right, to the downside, right? So that's what you need to watch for. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.